let's start with, what are the investment challenges for public and private real estate owners?
It's we're actually having what I think we're calling a bit of a dead cat bounce, because we are seeing quite a lot of activity. I think people have been trapped in their homes and looking looking online at what they might be able to buy. People have been able to save a bit more where their jobs haven't been affected. So suddenly they find themselves thinking, I'm close to the deposit that I thought I was a year away from. We're starting to see people feeling a bit more uncertain about their futures. We're seeing huge problems with fire safety, EWS legislation. That is really affecting people's ability to raise mortgages. We're really starting to see a lot of our shared owners who live in our homes who are part of the kind of trapped population in terms of not being able to sell their homes and getting zero valuations. So whilst the last few months have been surprisingly buoyant, I can see that it's now starting to slow down.
Nine Elms, Covent Garden, Thamesmead, Old Oak, so these really large scale strategic projects. And I think the challenges for those is always trying to get the mix of the public sector funding, the private sector finance together in the right combination at the right time, at the right point in the market cycle, that actually something can happen. And each of those projects has faced their own different challenges, but often it's the need for the public sector funding to come first to unlock an opportunity before the private sector finance can follow, and kind of getting Treasury to recognise that really there isn't the private market out there that's willing to kind of put 100 million, 200 million up front, or often significantly more, to actually make these projects happen.
Many of the private developers that we would work with would typically go to an alternative debt fund to secure development financing to support their projects. And as you may know, a number of those debt funds have pulled out of the market in light of COVID, and or significantly retrenched in terms of the amount of leverage and capital they're willing to put in. And for private developers, obviously, there's usually a very limited amount of equity that they're able to deploy. They may have a number of different projects on the go at the same time, and so they're looking to make their money go as far as possible. So that has been one of the main constraints over COVID. We have seen projects be financed, but not on the same terms that we were anticipating, in the pre-COVID world. And we've also seen a number of developments that we might come onto in terms of how projects are likely to be financed going forward. So, for example, projects that have been caught out halfway through the development process, and the existing finance provider has been unwilling or unable to extend the development finance, and they're very close to completion. We've seen a number of new funders come into the market looking to fill that exact gap to help get projects over the line. So there has been a sort of a channeling of capital into the private developments.
I'd echo what everyone said to date in terms of the challenges, and I think uncertainty is probably the key word here. There's uncertainty from Brexit and the whatever deal may or may not happen after December. There's uncertainty from building change. There's uncertainty around climate change and decent homes and what everybody's got to put into the thing. There's uncertainty in terms of money and the terms. There's uncertainty in terms of the planning system. So all of these things combined make it very, very difficult to put together a sensible business plan to enable delivery of housing. People are going to want generally more bigger homes now, further out, because they need the space to be able to work from home. And we've had a lot of conversations, and some people are saying they desperately miss being able to come into the office and want to be coming into the office. Others are saying they desperately, want to be able to stay at home for a larger portion of the day. So I think it is going to change how we work and live, but we're not anywhere close to being able to understand exactly how.
What we're finding, again, when you're a slightly smaller business and you're doing a development there which has got 100 homes for rent, for example, rather than 150 or 200 or 250, is that the pool of capital, which is still of an institutional quality that wants to be involved, is of course a lot smaller as well. So there's as it gets smaller, and in terms of thinking about how you can bring forward developments which are still of a good quality, that are say 50 homes for rent or 75 homes for rent, is that actually the money isn't necessarily there for it.
There's less demand today from investors for commercial real estate. And the reason for that is because there's less certainty for the need of occupants, tenants, to pay to occupy that real estate space. But one thing that's very, very clear is that there's no shortage of demand, underlying demand for good, cheap, affordable, quality residential space. So you put that together, long-term cash flows, a good social impact, and an underlying demand for it. And this is an asset class for which there's huge demand. But it requires intensive management. It requires expertise. There's a lot of expertise on this panel today, but out there in the wide world, a lot of people are put off by the notion that they need to look after real estate assets. That's quite difficult for some people. And as I referred to earlier on, equity market volatility puts people off from listed real estate. But we're seeing demand for this sort of asset class. Only last week, the first IPO, the first initial public offering on the stock markets in the UK in real estate for over 3 years was announced, and it is for social housing aimed at homeless people as tenants.
Big challenge that's just been talked about in terms of where are investors going to search for assets and product in the future. We've talked about this idea, we're going to see more people, are we going to see more people moving out of cities to live in more suburban areas? Is that trend going to continue? Is it sustainable in the context of the planning white paper and the idea of growth that's set out there? But at the same time, what's going to happen to cities themselves? We've touched on this. What's going to happen to the regeneration of cities? My view long term is I think cities will become more places which are about living, but better quality living than we have now. More space, more green space, more space for networking and connectivity. So it won't just be about a retail and a commercial destination. It's about where people will come to. I think there's going to be huge investor interest in beds as this kind of unfolds. I think there's going to be huge investor interest in beds. I don't see it just about homes and housing. For me, in terms of what we do at PFP, it's about affordable housing, PRS, retirement rental housing, student housing, homelessness accommodation. It's the broad spread of beds. We're seeing already quite a lot of investor interest.
Let's move on to our next question. How is the real estate funding landscape changing, and what opportunities does this provide for investors, developers and asset owners?
Area where it will be interesting to look at what models could work is around infrastructure. I know Louise mentioned it earlier. It's just, at the moment, that model just doesn't work in terms of expecting housing to deliver everything and expecting a developer to forward fund. So I think that is an area where either through funds or through funds working with government to provide that sort of early capital at a lower expectation of return, but maybe for a longer period might be a way of unlocking that.
Another thing that I've certainly observed is just getting new players into the funding mix. So not a scheme that I've been involved in, just one that I kind of saw announced recently, but it was a scheme, Many Down in Basingstoke, and that actually brought together kind of local authority, might have had kind of county council money in there as well, the Welcome Trust as a kind of more patient capital investor and a development manager. So a scheme which would perhaps have ordinarily been brought forward by a strat land developer and then sold off to house builders, has been kind of brought forward in quite a different way, and I'd imagine hopefully with an overall lower cost of capital that enables the project to come forward. But it's very much that mix of different funding sources and all of those partners really talking each other's language, and being able to kind of create the overall mix of financing that actually means that projects of a great quality can be brought forward.
The one that I thought was really interesting was Jackie's point around modern methods of construction. I mean, we all know how how bringing modern methods of construction could be really catalyze a change in the way that we develop properties in terms of consistency of product, quality control, speed of delivery, not disrupting the local communities when you build projects. But the lenders that I speak with are still getting their heads around how they underwrite these kind of products. So it's something that's really many of them already look at them, obviously, but it's still a learning curve for many of the alternative debt funds, for example. So I think I sort of watch this space, and hopefully people will start to focus more on those kinds of construction methodologies.
In terms of kind of diversity and inclusion, is another area that we're obviously looking at in a lot more detail at the moment. And one of the things that I've recently done with a new deal with Mount Anvil, where we've got a development finance agreement with them, we've built in a diversity and inclusion action plan clause, which is tied to the investment that we give them. They can be, if they breach that, they can be in default of their loan. And we worked really closely with them to develop a diversity action plan for them as an organisation, but also not only focusing internally, but also focusing on the properties that they're building. And that's something that we're looking to as to how we can roll that out in an effective way with any of our funding and investment.
So final thought was again the rise in, it's obviously been done already, but the rise in particularly as sort of public sector landowners not giving away in the same way their crown jewels, which is their land, and therefore, you know, finding other ways to participate with private sector in bringing forward land for development. And I touched upon one example of that earlier, which was the sort of income strip model. But you know, basically having an arrangement whereby you know, a lease is granted for a period of time, and ultimately after some financing is repaid, and you know, 40, 50 years later, and after some surplus income is received, then the asset returns to to that let's say local authority.
One of the things that I've come across often in my career when dealing with local authority, public sector, private sector partnerships is this sense, and I'm talking now particularly about regeneration rather than new development, where there's a need to get buy-in and support from the existing community. And you know, you hear about horrible words like decanting people from site to site, and I'm aware of several of these in London in particular, which the schemes which have stalled because of the inability to get community buy-in, and of course that's bad, because other things being equal, everybody wants newer, better accommodation to live in. One of the things that I think would be quite nice from IPSX would be if the developers could be encouraged to think about their community infrastructure levy being a grant of shares to the tenants. Just give the tenants free shares. So rather than the old ideas of Section 106 payments being cash given to the local authority, how about just give shares to the tenants, and they literally own their community going forward?
I think we are seeing some relationships starting to develop now with large and small SME builders, so touch that point because it's being picked up by various people, where people are coming to us saying, well, what do you want to buy? How can we have much more of a long-term partnership-based arrangement where we as a house builder will sacrifice margin in return for longevity of a relationship and steady, predictable returns, and we will acquire assets in, you know, at scale and volume. And I guess the benefit of PFP and L&Q and, you know, large RPs is we can have, you know, quite large scale discussions about those things and across multiple tenures. So I think we're really interesting to house builders, and we should be much more interesting to house builders than I think some house builders think. But I am starting to see definite change in that space where some of them want that more, what I would say is a productive long-term discussion that, you know, gives them sustainability in terms of income streams and revenue, and gives us the assets that we actually want access to.